Hi, welcome back to this course on infrastructure finance. This is lecture 6 on this course, and we will continue with what we have been doing for the last 3 lectures, which is to understand some of the basics of financial management. This is part 4 of this module on basics of financial management. But before we get into that, let us spend some time trying to discussing the 2 thought questions that we put forward in the lecture number 5. Question number 1 is, what is the advantage that depreciation provides to companies? Have you been able to think through that? First of all, let us understand the concept behind depreciation. There are several fundamental concepts based on which financial statements are developed, one of which is the matching concept. We saw the matching concept in the balance sheet, which indicated that the sources of funds would have to be matched with that of uses of funds. So the matching concept works little bit differently as far as the profit and loss account is concerned. In a profit and loss statement, the matching statement is used as follows. Once revenues for an accounting period are recognized, we should also recognize the expenses that are incurred in generating those revenues. That is, the revenues are matched against the expenses that are incurred in generating those revenues. Now, if you look at fixed assets are considered as an investment and they provide benefits over many years. Fixed assets are needed to generate the revenues. So if you really look at it from that perspective, fixed assets is one of the contributors for generating revenues, and the investment that is being made in the fixed asset has to be recognized as well in generating these revenues. But if we consider the fact that fixed assets provide benefits over a period of many years, we will have to account only a part of the economic life of the fixed assets that has been used to generate the revenues for a particular year. Remember, we talked about an accounting period concept, and if we assume that a profit and loss account is for 1 year, then we will have to account for that portion of the fixed asset which we would have used in that 1 year out of the entire economic life of the asset. So conceptually, depreciation refers to that portion of the economic life that has been used during that year to generate the revenues. Let us discuss it by a simple example. For example, if we actually purchase a car and that car has an economic life of 5 years, and for 1 year we would have considered used 1/5 of the economic value of the car. So the depreciation that we would account for in a particular year would be 20% of the value of the asset that we have acquired. So depreciation essentially helps us to be consistent with the matching concept that is used in financial accounting. The next question that we have to also answer is, assets are of different kind. Some assets are completed and some assets are classified as capital work in progress. Let us look at what could be a capital work in progress in the case of NTPC. So NTPC is a power generating company, and constructing a power generating station takes many years. If we assume that as on 31st March 2012, when the balance sheet had been prepared, if a station has been only 50% complete, then it would be classified under capital work in progress. That is, unless until the investment is fully complete, it cannot be used for generating power. So they are referred as capital work in progress. Do we have to depreciate capital work in progress? The answer is no, because unless until the assets are commissioned, unless until the plant start generating power, there are no revenues that are attributed to that asset. So therefore it actually violates the matching concept if we start depreciating the capital work in progress. We should also remember that the economic life of the asset does not come into picture unless the asset is fully complete. So therefore from several perspectives we have to kind of say that in the case of capital work in progress, depreciation is not arise. Now there are some of the other factors of depreciation that we have to also be aware of. First is depreciation differs from other expenses. For example, if you look at the profit and loss account, we have several categories of expenses such as fuel, administration expenses and so on. So depreciation differs from many of these expense categories. How does it differ? Difference number 1, other expenses are recognized in the same accounting period in which they are incurred. So if you assume that fuel is an expense, we recognize the expense that has been incurred towards fuel in the same period in which they are incurred, whereas in the case of depreciation that is not the case. Depreciation arises in the case of investment fixed assets, and these investments need to be made upfront before they can be depreciated as an expense. So that is, an investment made in the past would essentially be treated for depreciation in the future. So these are all not cash flows that are incurred in the same period as that of revenues. So depreciation is a cash outflow that has already been incurred. Remember, if we have to depreciate a fixed asset, the fixed asset should have already been commissioned, and the investment that are necessary for commissioning would have already been incurred. So that is the difference as compared to several other expense categories. An important difference that also needs to be kept in mind is, though depreciation is treated as an expense, there is no cash outflow during the accounting period, simply because the cash investment has already been incurred and it is not going to be incurred during the particular accounting period under consideration. Let us quickly look at the schematic of the profit and loss account to understand some of the advantages of depreciation. So in a profit and loss account we have revenues, which is the income that the firm gets by way of selling its products and services, and then we have several expenses such as fuel, salaries, the interest paid on the borrowings, and then depreciation and administration, etc. So revenues net of expenses would give the profit before tax. Now after computing the profit before tax, we calculate the income tax that the corporation has to pay for the revenue for the particular period, and net of corporate income tax is your profit after tax. Now if you look at depreciation, depreciation is considered as an expense. So that means a depreciation is accounted for before calculating the profit before tax. So therefore depreciation gives a kind of a tax benefit for the companies. Because of the fact that depreciation is treated as an expense, the company pays a lower tax as compared to what it would have paid if depreciation has not been accounted for. So investment in fixed assets acts as an incentive for companies because the depreciation that the companies can claim out of these investments enjoys tax benefits. So these tax shields can be extremely valuable for companies. Let us go to the second thought question. The question was, can the company make profits but at the same time fall short of cash? Have you been able to think on this? Let us discuss it now. If there are large delays in receiving payments from the customers, then a company can experience cash shortfall. How? The companies make profit from revenues, but cash is obtained only when customer pays. Let us consider how the revenues occur in the case of a company. The revenues occur as soon as the company supplies a product or a service to the customer and the customer accepts the invoice or the bill raised by the company. As soon as the bill is accepted, the company recognizes the revenues in its statements of account. But as we have seen before, most of the companies enjoy credit for the various products and services that it consumes. So though the company might have actually received the products and services and consumed, it might not have actually paid the company because it is enjoying a credit period. So till the time the customer actually makes the payment, the goods and products that are supplied is reflected under the accounts receivable in the balance sheet. So if the customer delays payment, the level of accounts receivable keeps on increasing, but it does not in any way affect the revenues because the customer has accepted and consumed the products and services. The revenues would keep on increasing and it can result in a higher profit, but since the customer has not paid the bill, it would be remaining as accounts receivable and leading to a shortfall in cash. When the customer starts paying his bill, then the accounts receivable is adjusted accordingly and the cash levels increase. So this leads to a situation where we can have a company making profits, but we can also have a situation where they can have cash shortfalls. In many public sector companies we can see this situation where there can be a high level of accounts receivable. Let us take the case of NTPC. NTPC has a higher level of accounts receivable as compared to several other companies. What could be the reason? The reason is most of the customers which purchase power are the state electricity boards, and the state electricity boards can delay payments that are due to NTPC. So therefore there could be instances where this high level of accounts receivable can actually have an adverse impact on the cash levels of the company. Now let us go to what we are supposed to discuss today, which is to really look at the third part of the financial statement. In a financial statement we have seen that there are broadly three statements. One is the balance sheet, the profit and loss account, and the third, the cash flow statement. So the cash flow statement is going to be the focus of this lecture. What is cash? Let us, for example, somebody asks you how much cash do you have, what would be the response that you are going to give? Most likely you are going to say the amount of cash that you are going to have in your wallet at that point in time. So you may respond that you have 100 rupees, you may have respond that you have 200, 300 and so on. But from the perspective of the company, cash is having a slightly different meaning. So what is the meaning? Cash does not mean only currency. So as I was mentioning a while ago, when somebody asks you how much cash do you have, you may actually indicate only the amount of currency that you have at that point in time. But as far as the company is concerned, it includes, apart from currency, several other items as well. So cash includes the deposits that the company has made in various banks, and it also includes the checks that the company has received for from its customers, but it is yet to be deposited in its bank account. In addition, cash also includes some of the other items such as treasury bills, certificates of deposit, etc. So these are all investments which can be converted to cash at a very short notice. So for all practical purposes, these are considered to be as liquid or as convenient as that of having cash. What is the advantage of having cash? The advantage of having cash is that it can be easily used for several transactions, and some of the cash equivalents such as treasury bills have the same advantage in that they can be easily converted to cash at very short notice. So when we say cash from a company's perspective, it does not mean only currency, but also includes other items such as the deposits in commercial banks, and also cash equivalents such as treasury bills and certificates of deposit. So the next question that I have is, why would a company have cash? If we look at the balance sheet of NTPC, the level of cash that the company has is indicated in the current assets. So NTPC has a cash and bank balance of 16,146.11 crore as of 31/3/2012. So why should the company have such high levels of cash in a book of accounts? Remember, we will have to account for the fact that the amount as cash or cash equivalents does not yield any major returns as compared to that of an investing in long term investments or in fixed assets. So despite the fact that cash does not give any returns, companies have accumulated large amounts of cash. What could be the reasons? The reasons are mainly two. The first is the transactions motive. Remember, cash also represents convenience. The companies would need to pay its suppliers, the company needs to pay salaries to its employees. So the company needs cash for various purposes to meet its day-to-day obligations. At the same time, the company also receives cash from its customers. Now, if all the cash that the company receives are deposited in, let us say, a long term investments giving higher returns, whenever the company needs a cash to meet its day-to-day operations, the company would have to necessarily liquidate some of its existing investments and then use the cash that comes out of that process. Now this can be time consuming, and in some cases this can also result in transaction costs. For example, whenever an investment is broken down or liquidated, there can be additional charges that are charged. So from a purely transactions motive, companies would like to avoid this kind of transaction costs. So the reason for holding cash is from a transactions motive. It is very similar to many of us individuals. At any point in time we keep certain amount of cash in our wallet, isn't it? Why do we do that? We can always go to the bank whenever we need a cash requirement and then withdraw, but we all know that there is a cost associated with it in terms of the time spent by repeatedly going to a bank or an ATM machine. So to avoid these kinds of transaction costs, there is a certain amount of cash that we keep as a buffer at all times. Same is the case with companies. The companies would also have a certain amount of cash to carry their day-to-day operations, which minimizes their transaction costs. The second reason for companies to hold cash is by way of the need for maintaining what are called as compensating balances. Remember, the company would have to avail services of banks for various purposes. It could be for obtaining a loan, it could be for obtaining other services such as an overdraft facility, bank guarantees, and so on and so forth. So whenever banks provide this kind of services to the companies, there is a requirement that the company makes certain amount of cash deposit in the bank. So these are called as compensating balances. That is, corporations would have to maintain certain amount of cash balances under various bank deposits to avail the services that the banks normally provide. So these are the two main reasons for the companies to hold cash. Now let us look at the cash flow statement of NTPC. This is a snapshot of a part of the cash flow statement. What is the first thing that you can observe? We have already seen the financial statements such as the balance sheet and the profit and loss account, and this is the cash flow statement. So if you look at the first line of the cash flow statement, it has a similarity with what we have seen in the balance sheet, with what we have seen in the profit and loss account. The profit and loss account is for a particular duration, and so is the cash flow statement. While the balance sheet is a snapshot of a particular point in time, both the profit and loss account and the cash flow statement is for a particular duration. So in this case, the cash flow statement that is shown is for the year ended 31/3/2012. So we will spend some time discussing the various line items that we see in this cash flow statement. Okay, now if you look at the cash flow statement, it largely consists of three broad categories of cash flows. The first is the cash flow from operating activities. So the cash flow statement indicates the cash flow from operating activities as 13,866.57 crores. The second category of cash flows is cash flow from investing activities. The cash flow from investing activities indicates a cash flow of negative 11,036.61 crores. So what do we mean by a negative cash flow? In finance, the general notation is all cash inflows are considered as positive and all cash flows are shown as a negative. So when we have a cash flow from investing activities as a negative number, what this indicates is that the company has made more investments as compared to the assets that it has divested. So the company has actually invested more than what it has actually sold off its previous investments. The third category is the cash flow from financing activities. Again, if you look at it, the cash flow from financing activity is a negative number. It is negative 2869.11 crores. So again, this indicates that the company actually has not raised capital during the year, but instead it has actually paid more to its investors as compared to the amount that it has raised from the investors. So the net cash flow from financing activities is negative. Now if we net all the cash flows from these three different cash flows, operations, investments and financing, what we get is a net addition in cash and cash equivalent, which is negative 39.15 crores. So for the year ending 31st March 2012, what we see is a situation where the company has actually used more cash. It is a negative number, and therefore the interpretation is the company has actually used more cash than it has actually obtained during the year. Now the opening cash and cash balance is 16,185.26 crores. So the opening cash and cash equivalent is a number that we can also obtain from the balance sheet. If you look at the balance sheet for the year ending 31st March 2011, under the current assets category, you will find the value of the cash and bank balances to be 16,185.26 crores. So this will form the opening cash and cash equivalent for the year ending 31st March 2012. That is, the cash and cash equivalent balance at the end of the previous year would form the opening cash and cash equivalents for the subsequent year, and if we add the addition in cash and cash equivalents during the year, we would get the closing cash and cash equivalents. So the closing cash and cash equivalents is 16,146.11 crores. Now you will find this closing cash balance in the cash flow statement also matches with the cash and bank balances value in the balance sheet. So this indicates that there is an integrity, there is a connect between the three financial statements. They are not three separate individual statements, but they are statements that are connected. They are statements that provide different aspects of the financing of the company's businesses. So when we are trying to understand the company's financial position, it is important that we look at all the three financial statements in toto and not in isolation. Now let us look at the details of the three cash flow streams. What are the different items that are accounted for in these three cash flow streams? First, we will start with the cash flow from operating activities. So I have listed out here some of the major items that comprise the cash flow from operating activities. The first is the profits from business. Remember, during the year the company generates revenues, and after meeting all the expenses it makes some profit. So this is the profit from business. So this is obtained from the profit and loss account. The profit and loss account indicates how much of profit the company has actually made during the year, and that actually is contributing to the cash flow from operating activities. The second item is depreciation. If you really look at what we have discussed on depreciation, we would be aware that depreciation is an expense, but it does not result in any cash outflow. But while we are calculating the profit after tax, we always account for depreciation as an expense. But since depreciation does not result in any cash outflow, while determining the total cash flow from operating activities, depreciation has to be added back into our calculations. The third is the item pertaining to dividends and interest income. The company would have made various investments, either by way of purchasing bonds, or it could have also made investments in the equity capital in other companies. So examples of this could be a company investing in subsidiary companies. So remember, there are some restrictions in terms of companies making direct equity purchases in the stock markets, but the company can actually invest in the share capital of its subsidiary companies. So any dividend income that the company receives out of such investments in subsidiary companies is also considered as a part of a cash flow from operating activities. After considering all of this, we also have to make adjustments for the working capital. What is working capital? Working capital is nothing but the amount of current assets and current liabilities that we have in the balance sheet. Net working capital is often referred as current assets net of current liabilities. So whenever we have working capital, it also affects our cash position. We have seen in the beginning of this lecture how even though a company is making profits, it can lead to cash shortfalls. So we will have to make for adjustments, changes in working capital while determining the cash flow from operating activities. So what kind of adjustments do we have to make? We have to account for any increase or a decrease in trade receivables. Remember, whenever there is an increase in trade receivable, that means the customer actually has not paid the company. So there is a short of cash in the books of the company because the customer has not yet paid. So any increase in trade receivables is therefore considered as a cash outflow. It is not necessarily a cash outflow, but that is a cash that is stuck in accounts receivable, but it is not available to be used for other purposes. Since it is not available to be used for other purposes, it is treated as a cash outflow. Same is the case with inventories. If you look at any increase in the level of inventory is treated as equivalent to that of a cash outflow. Now we also have to remember the fact that the vice versa also holds good. If there is a decrease in trade receivables, then it is considered as equivalent to that of a cash inflow, because the customers have actually started paying early. So to that extent, the additional cash is available for the corporation to be used for its other purposes. Same is the case with inventories. If there is a lower amount of inventory, then there is an additional cash that gets released into the system. So when we are determining the cash flow from operating activities, we will have to account for the changes in the working capital levels in addition to the other cash flows that we get from the profit and loss account. Next we will look at the second category of the cash flow statement, which is the cash flow from investing activities. What are the cash flows that has to be accounted for under the investing activities? The main cash flows under this category include purchase of fixed assets. Remember, fixed assets are investments that the company makes to support the operations of the business, and these assets are seen as more of an investment and not as an expense. Because purchase of a fixed asset is a cash flow related to an investment activity, it is shown under the cash flow from investing activities. So, any purchase of fixed asset results in a cash outflow, and therefore in a cash flow statement this should be shown as a negative value. A disposal of fixed asset in the same way leads to a cash inflow into the company, because we are selling a fixed asset, and in return for selling the fixed asset the company receives cash. So, disposal of fixed assets will lead to a positive value in the cash flow from investment activities. The company also makes various non-current investments. Examples could be investment in subsidiaries, investment in joint ventures, and so on and so forth. So, any investments in this kind of subsidiaries or joint ventures will lead to an outflow and will be shown as a negative value, whereas any divestiture or exit from these subsidiaries and joint ventures will be seen as a cash inflow to the company and thereby shown as a positive number in the cash flow. The company could also be making purchase of other investments, such as investing in long term government bonds, investing in certain type of mutual funds, and so on. Since these are all investments that are of a long term nature, this will be clubbed under the cash flow from investing activities, and any purchase would lead to a cash outflow, and any sale of such investments will lead to a cash inflow. And whenever there is an outflow or an inflow, it will be shown with the appropriate sign in the cash flow statements. Now, while calculating and determining the cash flows, it is very important for us to use the appropriate signs for each of the values. A positive sign for a cash inflow or equivalent to that of a cash inflow, and a negative sign for a cash outflow or equivalent to that of a cash outflow. Let us now look at the major cash flow categories under the cash flow from financing activities. The cash flow from financing activities represent those cash flows pertaining to the various financing activities. Remember, we talked about two fundamental aspects related to financial management in a company, which is investment and financing. We have looked at the cash flow pertaining to investments. Now, we will also have to consider the cash flow pertaining to financing. So, cash flow from financing could be how the firm raises capital. The firm raises capital by way of equity. It could also raise capital by way of long term borrowings. So, any cash flows that are associated with these sources of financing are clubbed under the cash flow from financing activities. If the company is making a long term borrowing, then it leads to a cash inflow. So, the amount that the company has borrowed is shown as a positive cash flow under the cash flow from financing activities. At the same time, if the company repays some of its earlier borrowings, then it results in a cash outflow, and that is shown as an outflow in that is shown as a negative value in the cash flow from financing activities. Similarly, if the company has raised capital from various shareholders in the form of equity, it is shown as a positive flow. But if the company declared a dividend and paid dividends to its existing shareholders, it is considered as an outflow. So whenever we are having dividend distribution, it is shown as a negative value. Whenever the firm raises capital, it is shown as a positive value. We also have interest paid on borrowings. The interest that is paid on borrowings is very similar to the dividends that the company pays to its equity shareholders, in the sense that that is a return on capital that the firm has obtained from its investors, and this is a cash flow that is pertaining to its financing activity, and therefore it is shown under the cash flow from financing activities. So taken together, the cash flows pertaining to operations, cash flow pertaining to investment, cash flow pertaining to financing represents all the cash flow streams that the company would get from various operations of the company. For us to get a holistic view of the company's cash flows, we will have to look at all the three cash flows together and not in isolation. Now let us look at the thought questions for this session. Question number 1. If the company delays making payments to its suppliers, how would the financial statements be affected? Now we will have to consider the fact that when we say financial statements, we include all the three that we have discussed so far: the balance sheet, the profit and loss account, and the cash flow statement. So I want you to think about, if the company is delaying payments to its suppliers, let us assume the company was previously making payments to its suppliers in 2 months. Instead of making the payments to its suppliers in 2 months, if it starts making the payment by the end of 3 months, how will this get reflected in the financial statements? Which are the line items that will get affected? And we should also be in a position to estimate the direction that it would get affected. That is, will there be an increase or will there be a decrease? Will it be a positive or will it be a negative sign? All right. The second question: how can we use the information in financial statements to analyze the performance of companies? Now, what is the objective of looking at the various financial statements? As a manager, our objective in looking at and understanding these financial statements is to be able to evaluate a company's performance. So how do we actually look at the information from these financial statements and understand about the company's financial performance? what information to use and what can we interpret from that information. So this will also be the focus of our next lecture, but before we do that I would want you to think as to what we can interpret from the information from these financial statements. If you want to know more about the financial statements, you can continue to refer to the reading material that I have suggested in the past few lectures. Thank you and see you in lecture 7.